we are in the late stages of a big debt cycle. We have bottomed in that cycle, and we're expecting interest rates to go up over the next 5, 10, 15 years. I am expecting a near-term rally in the dollar, but longer term, I think the dollar has structural problems in the S&P 500. And the daily data are suggesting down in the near term as well into October, November.
The U.S. national debt surpassed $37 trillion this week. It's a monumental figure, and it just keeps climbing higher. Where does this sit into the multi-decade debt schedule, and how did this debt cycle affect our economy and markets? Meanwhile, China recently just sanctioned 6 U.S. companies this week and halted soybean purchases, escalating the trade war. So we'll talk about how this escalation may impact the U.S. dollar, and ultimately how market cycles can be analyzed and used by investors. Joining us today is Richard Smith. He is the executive chairman of the Foundation for the Study of Cycles, and he's studied 80 to 100-year debt cycles and tracks real-time liquidity indicators to identify when financial systems reach breaking points. Welcome to the show, Richard. Very interesting stuff you're working on, so I'm happy to have you on the show.
Great to be here.
I was just looking up your website, and the Foundation for the Study of Cycles dates back to 1941, after the founder, Edward Dewey, discovered quiescent cycles in nature and business. I'd like you to please expand on, well, not just the history of the organization itself, but the kind of work that you do for the Foundation of Cycles and how that applies to markets. Let's start there.
Well, our origins were in economics. Edward Dewey was the chief economist in the Hoover administration, and he was tasked with explaining to President Hoover what caused the stock market crash and ensuing depression. And he talked to 100 economists and got 100 different answers, and decided that he needed to look beyond just economics. So he became aware of cycles in economics, and then he connected that with cycles in wildlife biology, with solar cycles. Chairman of the Smithsonian at the time was on the board, along with the head of the geology department at Yale. And it was quite an interdisciplinary dynamic group studying cycles across all kinds of different phenomena. So I think it was really the precursor to what today we might call complexity science. I actually have my PhD in system science. And so I think we are pursuing an interdisciplinary approach to understanding cycles in our world, and certainly in the economy. And
is there a scientific reason as to why economic cycles happen? In other words, why events repeat themselves over a fixed interval?
My own belief about it is that markets are the collective actions of human beings, and human beings are very cyclical creatures by our nature, right? So it's just very natural for things to get going in one direction, which is what I think is what's happening right now, for example, and get kind of strained, but everybody gets further and further to one side of the boat, and then says, I'm not so sure, this boat might not tip over. And so then we start moving back to the other side of the boat, and we get cycles. So I think cycles are part of life on Earth. I think they're part of humanity. And I think it's just the natural behavior of collections of human beings doing things together.
How is a market cycle different from, let's say, a pattern? Or do we use those words interchangeably in your profession?
A market cycle is a pattern. In particular, it's a repeating pattern that repeats at fairly predictable intervals of time.
Okay, so let's apply that. So you've measured debt cycles. You've studied them at 100 to or 80 to 100-year intervals. The U.S., like I mentioned in the beginning, just surpassed $37 trillion. Now, can you maybe help us put this number into context according to your work?
Yeah, so certainly Ray Dalio has been sounding the alarm on big debt cycles. He's done some extraordinary work there, and he and others agree that we are in the late stages of a big debt cycle that typically are 80 to 100 years. I've studied interest rates in US debt going back to 1787, for example, and we can see a cycle all the way back there, and that we have bottomed in that cycle, and we're expecting interest rates to go up over the next 5, 10, 15 years. And when you couple that with the massive debt that the US government has to refinance continuously, every basis point and 100 basis points that interest rates move up means higher servicing costs on that debt. So that is the essence of a big debt cycle. We're clearly at unsustainable levels right now. There's no real indication that the deficit is about to come down in a meaningful way or that we're about to pay off our debts. So those pressures, those cyclical pressures of interest rates rising over the next 10 and 20 years, together with the levels of debt, are exactly the kind of situation that you have asymmetric risks.
I believe you have a chart to illustrate this point. Why don't we pull up this chart and take a look here? And yeah, so 1787 to 2022, debt cycles in 85-year increments. Now, in nominal terms, obviously this is an unprecedented level, but I guess adjusted for inflation and I guess also the growth of the debt right now, is it truly unprecedented that the debt is growing at this rate that we're presently seeing?
It is unprecedented, yes. I mean, we're at debt rates that we haven't seen since World War II. Okay.
Is there a reason as to why this is happening in our economy?
I believe the reason is the cycles, right? So, I mean, I think we've just gotten to such an extreme here. On this chart, I show, for example, this when 10-year yields back in the end of the 20 teens were down below 2% at 1%. That was absolutely unprecedented. This chart is about 3 years old at this point. So 10-year yields are up here closer above 4% now. So, this is like a beach ball being, held under the water here. And we would expect it to rise and pop up above the surface. And indeed, that's what's happened. And we expect this trend to continue for, this is 1983 down. So it's about a 85-year cycle. So that's 40 years on both sides of that cycle. Now, that's not, it doesn't correlate perfectly, but the pressure on rates is up and will continue to be up for a significant period of time.
Before we continue with the video, let me tell you about a very important topic: how to protect your privacy. Now, your private information doesn't just live in the inbox of your phone. It's being collected, packaged, and stored and tracked by data broker websites all over the internet, even without you knowing. That's where today's sponsor comes in, Delete Me. I use Delete Me to protect my privacy, and here's how. It helps you. It's a platform that helps you remove your personal data, like your name, address, and contact info from hundreds of these data broker websites. When you sign up, you'll get a detailed privacy report showing where your data was found and what's already been removed. And Delete Me keeps working throughout the year, scanning and clearing your information regularly. It's an easy way to take back control of your digital footprint without trying to track everything down yourself. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout to get 20% off of US plans. Link down below, or scan the QR code to get started today.
Okay, so if you're expecting the 10-year yield to rise or the long end of the curve to rise, typically that coincides with higher inflation as well. As you can see on your chart, it peaked around the mid or the early 80s when there was very high double-digit inflation in the US. So are you also making the similar assumption on inflation, that it will also rise alongside this cycle?
I have a chart here of the CPI.
Mm-hmm.
This is the monthly data on the CPI, and it's the blue line here. This is our cycle analysis technology. The CPI here, as of the end of August, was about 2.94. You can see inflation is moving up now, not down. And this is a 64-month cycle in inflation. You can see it. We do what's called spectral analysis of the data, or Fourier analysis. And you can see a very sharp spike here at 64 months on the spectrum, and that's the cycle that we've plotted here. And we are moving into the early stages of an upcycle in the CPI. And this bottom indicator down here is a momentum indicator. It's a proprietary momentum indicator that shows that we're at quite low levels of momentum, but turning up as well. So this is another indication that even in the short term, there are inflation pressures in the economy, and they're not likely to abate, for at least another 12 to 18 months. So the Federal Reserve may try to lower rates more, but they're going to be struggling with sticky to higher inflation. And interestingly, also, there's a 67-month cycle in the unemployment rate. And we're also into a rising unemployment trend, according to that cycle as well, that still has some room to run. So yes, we are seeing higher pressures on unemployment, and we anticipated those a while ago. So there is pressure for the Fed to lower rates based on higher unemployment, but it's happening in the face of persistent and sticky and probably even rising inflation over the next 12 to 18 months. So the economy is in a difficult spot, and because we have this extreme debt and the problem of, as rates rise, the cost to service that debt rises. Again, I think it puts us in a situation that we call asymmetric risk, right? So if something unexpected happens, if things get surprisingly volatile, there's a big risk that everybody starts running for the exits.
So, Richard, markets, I'm talking about stocks in particular, are at all-time highs. Risk assets, including cryptos and Bitcoin in particular, reaching all new all-time highs. We haven't seen some of these cycles that you're talking about affect capital markets yet, or has it? I'll let you answer that. How does the uptick in inflation, how does the uptick in the long end of the curve, how does the uptick in unemployment, for example, how will that eventually impact markets?
So I think that what's happening right now is we are getting a relief rally with the idea that the Fed is going to lower rates. If they lower rates dramatically, I think that's going to create a significant problem for equities in the long run. Although, of course, it could lead to an explosive blow-off top rally. But let me show you maybe the most famous cycle. In fact, Edward Dewey wrote about this back in 1972 in his book that we brought back into print recently, Cycles: The Mysterious Forces That Trigger Events. And this is the S&P 500 weekly data right here. And let me just remove the cycle from the screen for the moment. But you can see down here in the spectrum, there's a very clear peak at around 188 weeks, which happens to be 42 months. And if we plot that cycle, we can see that it caught the last top, had a down move, and then we caught this top and had a down move, but now we've moved significantly higher, kind of defying the cycle. And that happens sometimes, but we also see that we've got these decreasing peaks in momentum. And this cycle dates back to the mid-1800s. You can track it back that far. And if I, even here, looking at all this data, if I take it all the way back to, how far do I have it? 1928, you can still see that this 183-week cycle is very prominent on the spectrum, which means that it's statistically significant in the data. So this is a very strong cycle. We are in the late stages of this cycle right now. And if I drill down and look at the daily data now, this is the daily data on the S&P 500. then we can see that the daily data, the cycles in the daily data are suggesting down in the near term as well into October, November.
How do you decide on the frequency of the troughs and the peaks? Because presumably you could just extend that, and that would change your analysis, right?
You do have to test different durations in the data. We try to get at least 4 or 5 iterations of a cycle that we want to validate with the data. But sometimes, like I just did on the S&P 500, we
Right.
went back all the way to 1928, and we can see that that cycle is very present and strong in the data consistently over that whole period of time. So when I see a cycle like that, that gives me a lot of confidence that it's something worth paying attention to, that it has persisted in the data for that many iterations. What is it, 20 times, 42 months is about 3.5 years. And all the way back to 1928, that's 100 years. So that's over 30 iterations of that cycle. And it's been statistically significant through all that time.
And the magnitude of gains or losses during bulls and bear cycles, do those repeat as well?
No, and cycles really don't give you magnitude. They're more about timing. So it's one of the ways you can get yourself in trouble with cycles is you can look at something that looks like it should have a big magnitude and it ends up not. But I do think right now that, as I've been saying, I do think there is an asymmetric risk because we are at a late stage of the debt cycle. We have rising inflation, we have rising unemployment, and we're also at the late stages of a pretty well-established 5.5-year liquidity cycle. And as liquidity starts to dry up, as spreads start to widen in credit, all of those things are warning signs for, when the music might stop, so to speak. But we're not there yet. The music hasn't stopped yet. People are still dancing.
Well, where does this debt situation go next? The $37 trillion situation. Does the Fed find a way to monetize this debt? Does the government just print its way out of it? Does inflation happen, or does eventually something break, and then we need to revisit the financial system altogether? What comes next?
My own view is what's called stagflation light, right? So I do think that the government is going to monetize the debt. I think that's inevitable. It has to be monetized. It just can't be paid off at these levels and have the economy continue to thrive. And so I do think we'll see debt monetization, and I think that that's going to make growth difficult, right? Because when you're monetizing the debt, that's called fiscal dominance, right? The debt needs of the government are dominating capital flows, and that makes growth difficult, and it does increase inflation. So that's the formula for stagflation. Low growth and maybe not runaway inflation, but certainly persistently sticky to gradually higher inflation.
What about the notion that nothing is going to change at all? If you take a look at the nominal value of debt, it's been rising pretty much in a straight line since the beginning of time. And so GDP has in most situations caught up. If GDP continues to keep up such that the debt to GDP ratio doesn't change dramatically to the upside, then nothing really changes. What credence do you give to that view?
I think it's problematic because I think nothing changing is the status quo that we're in right now is an incredible wealth divide, right? The lower income citizens, certainly in the United States, are not growing their wealth. It's mostly the upper, 1 to 5% that are growing their wealth, and that's where most of the wealth growth is happening. So that is a problem in our economy and in our society right now. I know that President Trump is really trying to do something about it. I'm not convinced that he is going to succeed, but everybody knows it's a problem, and the status quo is going to be problematic. I'd say it's status quo at best. So I believe that status quo isn't good enough right now to really solve the deeper systemic um, economic issues that we're experiencing in the United States.
Where does that leave the US dollar if, let's say, the wealth gap eventually or continues to widen? Some of these fundamental problems in our economy doesn't get fixed. We enter a stagflationary environment, like you mentioned. Does the dollar remain the world's de facto reserve currency?
I think that is the big question, right? I mean, that is the dollar as the world's reserve currency is really the linchpin of the global economy, period. That is the most baked in assumption that everybody has about how the world works, you know? And it's problematic. And I covered this pretty extensively on my YouTube channel last week, where I went over how the dollar and the treasuries work together, right? So treasuries are basically dollars. They're considered the most safest collateral in the world, and people exchange treasuries for dollars and vice versa. So if treasuries continue to kind of go down with yields going up, and that creates more pressure on the dollar. So you could always see a huge flight to safety rally in the dollar. And I think we could well see that soon because the dollar has been gone down too far, too fast. So I am kind of, from a cycles perspective, expecting a near-term rally in the dollar. But longer term, I think the dollar has structural problems, and it's not clear to me that the deglobalization and decoupling that we're all witnessing right now, although I think in some ways it's well-intentioned, I don't think that bodes well for the dollar longer term. And we know that President Trump wants the dollar lower to ultimately support American exports. So all of that seems to put the dollar in a fragile position to me. And meanwhile, the dollar is really the most basic assumption about how the global economy works is that the dollar is the reserve currency, and it's worth it. So I think that pressure on the dollar is going to be a problem.
So, per your explanation of treasuries are just like a collateral, and we're flooding the system with $37 trillion worth of basically treasuries. Does that make the collateral more or less reliable or trustworthy?
I think it makes the collateral less trustworthy. And I think that, if the deglobalization continues and other countries decide that they have to take care of number one, so to speak, and they stop buying our treasuries, the way the system works is, take a country like China, right? They make stuff and they sell it to us and they get dollars back in return, and then they trade those dollars for treasuries. So if we really are going to be decoupling from China, that's going to be a massive change in the flow of dollars and treasuries. And certainly China is one of the biggest holders of treasuries. They don't want treasuries to, plummet in value right away, right? So there's still some mutual interest in supporting treasuries. But these are definitely tensions that everybody needs to be aware of, and that, as I've been saying, I think create a situation of asymmetric risk where everybody can run for the exits at once.
Well, going back to your cycle analysis of the long-term yields going up now into a multi-year or multi-decade uptick of the yields and I guess bear market for bonds. Well, Trump wants the Federal Reserve to lower rates. And in fact, the next Fed chair will most likely be somebody that is pro-Trump and will lower rates. How does that affect your cycles analysis?
It doesn't affect the long-term cycles analysis. I think it certainly can affect the short-term cycles analysis. I think that we've seen that the Federal Reserve and the federal government can override the cycles for a period of time. But I think that ultimately that's going to be a short-sighted move that is going to make the asymmetric risks even more extreme.
Going back to China-US relations, like I mentioned in the beginning, new sanctions imposed by China. I think the broader question that I have is, does your cycles analysis analyze trends in emerging and or waning superpowers? In other words, the rise and fall of empires. Is that factored in per your analysis?
So cycles analysis can be done on any time series data. So if you have the data on the rise and fall of empires, and there have been studies on that. There was a famous professor, Raymond Wheeler, whose work was supported by the Foundation for the Study of Cycles, studying the rise and fall of empires together with climate. That is another theme that is coming up again today. People are researching how climate impacts economies and cultures. So I don't have that data myself. I don't have a source of that data, but I think people like Ray Dalio, another one, Peter Turchin from the Santa Fe Institute, who's been studying how, well, of course, there's Neil Howe and generational cycles, the fourth turning, right? But Peter Turchin studies what he calls cliodynamics. And one of the things he's looking at is the how basically as an economy grows and prospers, and then you get too many elites that are have gotten a great education and want to help lead, but there's not enough leadership chairs. So you end up getting this competition amongst elites in the late stages of these cycles as well. And I think that is a pretty good characterization of what we're experiencing today with social media, where you have everybody wanting to, have their own say, and a lot of people with a lot to say. So all of those things, I think, are very suggestive of these longer term superpower cycles. I don't have the data to study those myself, so I can't comment on them from the type of cycles analysis that we do, but certainly as a person interested in cycles, I'm following all those different researchers carefully.
So China is now currently buying fewer U.S. goods and sanctioning U.S. companies. Presumably, we're seeing this decoupling between China and the U.S. What will happen to treasuries demand?
If there truly is a decoupling, it'll absolutely impair the demand for treasuries, because China has been one of the biggest buyers of treasuries.
Okay.
I personally am not convinced that Trump or Xi really want the decoupling right now. I think there's a lot of gamesmanship going on. But again, that gamesmanship creates asymmetric risks. So I think that there will be a slow decoupling over time that will continue to contribute to higher treasury rates.
People have speculated, Ray Dalio himself has on Twitter X said that the return to the gold standard is possible, maybe not immediately, but a return to the Bretton Woods system is possible in our lifetimes. The Bretton Woods system, as you know, ended in the 70s. It's only about 80 years old now, if you factor in the start date, and you're tracking 80 to 100-year debt cycles. So maybe are we seeing the end of a current financial system?
I think that is absolutely something that we have to give some consideration to. These things are slow, they're unpredictable, but we absolutely are at the end of an 80-year cycle. And it's what Neil Howe's talking about in the fourth turning. If you're familiar with his work at all, we certainly see a generational gap, right? The unemployment in the youth right now is much higher than the unemployment for the boomers. There's generational warfare going on right now. And all of those things contribute to an intense time of swirling forces that feel very chaotic and ultimately will lead to change one way or another.
My final question for you, well, actually, it wasn't so much a question as a request. Can you please show us, using some of the tools and indicators that you have in your toolbox, how Bitcoin is going to look? Maybe you can apply a cycles analysis to Bitcoin. A lot of our viewers are interested here.
All right, so let me just start from scratch here. So I'm going to start out looking at weekly data on Bitcoin. going back to 2014. That's as long as it's available from Yahoo Finance. So if we look here, we see, so we've got 600 or about 700 weeks of data here. That's not really a lot for doing a cycles analysis. But if we look at, for example, one of the most prominent cycles on the chart here is this 84-week cycle. And we're seeing it at a topping phase of the cycle right now. And again, down here, we see this is a proprietary momentum indicator. It's called the cyclic RSI. And we can see that we have a series of descending tops in momentum while we have an ascending series of prices. So this is a classic momentum divergence situation. And the cycle is just past its peak. So on a weekly basis, I'd say that's of concern. And see this 84 week, then there's this 163 week, which you'll notice is 2 times 84. So there's often a harmonic relationship in cycles. And both of them together are suggestive of risk for a significant correction in Bitcoin. And if I drill down to the daily cycles in Bitcoin, again, let me just start this analysis from scratch now. So this is kind of a fractal approach to cycles analysis. Now we're looking at daily data, and we're going back just to June of 2022 or so here. We see a quite prominent cycle here at 58 days. Suggesting possibly a little more upside. And this 209-day cycle is also quite prominent. So on the daily charts, I think there's room for a little more upside in Bitcoin, maybe one last new high. But longer term, over the next year to 2 years, I think that together with the risk-off concerns in the economy period, that Bitcoin from a cycles perspective also is vulnerable to some cycle headwinds. At the same time, I do think that Bitcoin is enjoying some of the same benefits that gold is enjoying. I think that Bitcoin and gold together actually are quite a nice combination. And they are relatively uncorrelated to each other, so you get some good diversification between them. But I think as people are seriously asking themselves, is the US dollar going to be the reserve currency of the world? Then both gold and Bitcoin benefit from being a hedge against the worst case scenario there.
Excellent. Thank you very much, Richard. Where can we find your work?
Our most active space is YouTube at Cycles TV at FSC TV. And you can follow us and sign up for our newsletter at cycles.org. We are a not-for-profit. Our newsletter is about once a month, but we have several shows each week on YouTube, especially on Monday and Tuesday. My partner Lars von Tienen and myself lead that along with some other regular contributors. So that's the best place to keep in touch with our work.
And what I like about your channel is that it's not just about market cycles. You talk about the cycles of nature and life. So
yes.
Get a good breath
we've had some really interesting interviews. Marine permaculture was an interesting one recently. And we also have done some climate research interviews and lots more to come.
This is fascinating. Yeah, you're talking about the science behind societal cycles, DNA. Very interesting stuff. All right, well, we'll put the links down below, so make sure to follow Cycles TV and Richard's work there. Thank you again for coming on the show. We'll speak to you again soon. Take care for now.
Thank you, David.
Thank you for watching, and don't forget to like and subscribe.